me record her apologies up front. She is in an area where the reception is quite limited. A number of webinars have been taking place. I see quite a number of questions have been coming through on access to the content of the webinars. We'll try and make this available. In fact, we have created a link on the website www.tikzn.co.za, www.tikzn.co.za, and that link, there is an icon at the bottom right where you're able to click and then access some of the presentations from some of the sessions. At the moment, we've got the one from the finance work stream. We're busy consolidating all the presentations, and we'll upload them on the website. So please bear with us while we're trying to upload the same. But just to take you through, we've had an fourth industrial revolution work stream, which took place on the 27th of April. And during that work stream, really, it was quite interesting. A number of initiatives that have been driven from an 4IR perspective, and the fact that we have really not embraced technology effectively as South Africa. Quite a number of recommendations in terms of government preparedness and also access. You would have seen, if you've been participating in a lot of these webinars, that these platforms do eat up quite a lot of data. And as a result, if you are in an area where you don't have access, it creates a problem. So broadband connectivity within regions is quite important. And that's one of the resolutions that came out of that work stream to talk about connectivity in regions. And then we had one that dealt with finance, and the finance work stream looking at investments into the financial sector. Investments led by particularly looking at instruments that are being driven by government entities, KwaZulu-Natal Growth Fund, IDC, NEF, etc. So they presented a number of their instruments and key interventions that are driven by government. We also had one that dealt with red tape. Red tape is an area which is quite onerous on business, that impacts quite negatively on business as well. And also in the delays that we see in a number of the projects that are supposed to be implemented within our region. So we had quite a good and exhilarating discussion around red tape and issues in red tape. A session was held on the medical sector, looking at opportunities within the medical sector, PPE, not only PPE, but also pharmaceutical sector, etc., and how we're able to access this sector effectively and diligently within South Africa. Today's session, this morning we had one on tourism and access and how tourism has impacted on the province of KwaZulu-Natal. Now this session is on trade and investment. So on trade and investment, it will be cross-cutting if you think about it in terms of all the sectors and really trying to lay the foundation. And part of this work stream is really to look at key interventions that this work stream can drive. The conveners for this work stream, in fact, the convener is Ms. Pusi Mabusa, who's also our leader in terms of the BRICS Business Council, the chairperson of the BRICS Business Council, the South African chapter, who led a delegation to Brazil last year, and this year was supposed to go to Russia for the BRICS summit, but obviously there would be delays because of COVID and how COVID has impacted on the BRICS and such platforms. But over and above that, wearing her other hat, she's also chairperson of the IDC. Co-convener is Mr. Martin Cameron, an academic who has worked with us as KwaZulu-Natal, as well as the South African government through the DTIC, on trade data and the compilation and understanding of trade data, because that's always our biggest challenge in our country, ensuring that we've got relevant, up-to-date data that is credible. And through the University of the Northwest, they've done remarkable work. There's a platform called DSM that they run, which is absolutely amazing in terms of how they produce data, which we've worked very closely with them on, customize it for the province of KwaZulu-Natal. So that's one area that through Martin, as well as the team, Professor Viviers, Francois Faucher at the University of Northwest, they've been able to do cutting-edge information related to trade, to investments, and not only that, but also great advice to exporters on which markets to look at, etc. So in essence, this is just an introduction of the panel members that are here. Francois Faucher is also an expert at the University of the Northwest, has been driving a lot of the information related to COVID-19. And yeah, so when I have a question on COVID, the economics behind it, etc., I know who to call. I know Francois is the #1 person to speak to. That's just an introduction of this morning, just words of welcome. I will now hand over to the convener of this work group, Ms. Busi Mabusa, to really talk about the purpose and the key outcomes of the trade and investment work stream. And she will then, I will hand over to her. Ms. Mabusa, please, if you can take over.
Thank you so much, CEO, for those kind words of welcome. And welcome, everybody. It is quite pleasant for us to be able to interact with you this morning. And I must first of all acknowledge the MEC Dubengube, for her foresight and for thinking and for recognizing that we need to get together to discuss how we move forward in a world that we will be encountering for the very first time, I think for all of us. We chose for this investment and trade work stream to approach this very first webinar by requesting or providing a platform for us to engage with you as industry on your issues, on your top of mind concerns about the trade environment and about investment opportunities and challenges that you see, given the environment, which is very abnormal that we're in at the moment. So we are here, thankfully we have experts who are going to share some background information. However, we would like to spend more time listening to what you as industry stakeholders have to say about what solutions we should be looking for. We're of course hoping that the solutions will try to be as practical as possible and as within reach as possible. Just from the development finance perspective, we believe that capital going forward will be looking for countries and opportunities that have not been devastated by the COVID pandemic. We all know what has happened to the Western economies. And so far, it seems, thanks to the various governments in the African continent, and thanks most especially to the South African government, it seems that most of the countries in the African continent have been shielded from the worst impacts of this pandemic. Long may that last. If we are able to maintain that, then we are of the view that global capital will be seeking opportunities where it can be efficiently deployed and deployed to the advantage of the investors. However, we're not here to just talk about global capital. There is domestic capital opportunities as well and need. So many firms, small, medium, and large, will be looking to invest in their safety and health and safety improvements. A number of businesses will have to be investing in modernizing. We have seen that this pandemic has forced all of us to get onto digital platforms. Hopefully, as we invest, this will also allow us to improve efficiencies. Development finance institutions will be looking for entities that are looking for expansion capital or capital to repurpose their businesses. At the small and medium end of the spectrum, I believe that we will have to also invest, and unfortunately, this will be a function of time as well. We'll have to invest in trust by delivering products on time and by delivering products of high quality. In terms of trade, which is more on the downstream side of our work stream, the African continent has, in 2018, actually imported over $550 million worth of merchandise. Very sadly, colleagues, 64% of this was manufactured merchandise. I don't need to harp on our heavy reliance on commodity exports, something that clearly has to change and has to change as quickly as possible in order for us to maximize the opportunity. So let me pause here, ladies and gentlemen, and just once again remind you that as you receive the input from the experts, please know that we are also here largely to listen and to take back the input that you have to give us. Thank you so much.
Thank you so much for those introductory remarks. I think they are quite clear in terms of what would be expected of us in this webinar. I think the message is quite clear, is we need to listen to the comments and the concerns that are raised by yourselves, as well as your input. So please make sure that you put the questions through, let them come through the system so that we're able to then respond to those questions. Without any further ado, let me introduce Mr. Francois Foucher, who's going to then take us through economic and global impact of COVID. Francois will then do a presentation. Francois, I hand over to you.
Thank you very much, Neville. I'm going to share my screen to put up the slides. There you go. I hope everybody can see my screen now. Just going to minimize that. Excellent. Neville, Musi, thank you very much for the opportunity. I'm going to start straight away so we can stick to the schedule. I have a number of slides that I want to share with you guys. The title of the presentation is called At War with Ourselves, and you'll see why I've titled it like that. The first question, I think, which is paramount to ask in this pandemic, is the cure worse than the disease? And the reason I ask this is for the following. There's probably a 10% chance that some people may die from this virus. Most of us is actually going to get the virus, but most people don't die from the virus. But given the lockdown measures that not only South Africa are under at the moment, and so many other countries around the world, there's probably a 100% chance that millions of people will starve to death due to the cure. So as an introduction, what can we say about the pandemic? Well, first and foremost, it won't stop human progress, but it will certainly interrupt it. And the global economy has literally gone to hell in a handbasket overnight. So this is both a demand and a supply shock to the economy. In the literature, we refer to this as an externality. And it's very similar to the oil price fallout that we've seen over the last month, where supply completely overwhelms demand and the price reacts. So this shock at the moment is all front-loaded. The global financial crisis in 2008 was about 18 months of bad news. This all happened within less than a month. In the Great Depression, which started in 1929, it was a more gradual release of bad information and bad news over the period of about 3 years. But within less than a month, with this pandemic, stock markets, commodity prices, export demand, remittances, which are crucial for South Africa and developing countries, particularly in Africa, capital flows, capital market liquidity, credit spreads, employment, consumption, investment, capex, tourism, all have literally fallen free. It will certainly be a gradual battle for the various economies around the world to resurface. It was a very synchronized downturn, but I think lifting the lockdowns will be significantly less synchronized. And therein lies the big challenge. Because if we look at global supply chains, they do not like these interruptions. And it will damage many, many industries, and it will damage many global supply chains, especially the ones that operate in a very efficient inventory method. So to make light of the situation a little bit, if we look at this cartoon, this is Donald Trump and the president from Brazil. This is a hoax. Donald Trump said one day it's like a miracle, it will disappear. Brazil's guy says, get up and go back to work, it's just a cold. And Johnson very responsibly says, patch me through to Ramaphosa, I need to speak to a real president. And this is the president at the moment. There's a storm brewing. We are bracing for a very large storm in South Africa, and the economy is shivering. Some emergency measures have been announced, but this came like a bolt out of the blue. The leadership was very quick to react on the health management and the health crisis, which is fantastic to see. But the real leadership test lies in the economic rescue and recovery that is going to follow over the next 2 to 3 years. If we just look back to get more perspective over death tolls in previous pandemics around the world, we'll see that Black Death, or the so-called bubonic plague, took from the world population about 200 million people, it's estimated it. Smallpox, 400 years ago, took about 56 million. Spanish flu, various estimates, but probably around 50 million people in less than 3 years. If we continue, HIV and AIDS, between 25 to 35 million people, but that's over a period of the last 40 years. The third plague, the Asian flu, Russian flu, Hong Kong flu, the cholera outbreaks that we've seen, Japanese smallpox many, many moons ago, swine flu, about 200,000 people, and there's COVID-19. This slide is 5 or 6 days old, so at the moment the death toll, I believe, is slightly over 200,000 globally. But yellow fever, Ebola, and MERS and SARS have also taken people from the global population. We just need to be extremely careful and cautious with how we deal with the actual data that has been released from so many different countries, from so many different places around the world, before we jump to conclusions. If we look at some of the research that has been published by Oxfam, they estimate that about 500 million people will be forced into poverty due to the lockdown measures and the impacts on the various economies. The biggest impact in terms of number of people, rather, is East Asia and the Pacific, and Sub-Saharan Africa was expected to have close to 50 million people being pushed below the poverty line. So action is required. There's no doubt about that. These are exceptional times, and it calls for exceptional action. Governments literally have to do whatever it takes, and we have seen great commitment and reactions from many governments, but they must make sure that they keep the receipts of the rescue packages that are being dished out. We have seen a massive government response globally. About $8 trillion have been committed to bailouts around the world. If we look at the South African situation and we compare to emerging markets, for instance, we can see, according to the IMF policy tracker, that South Africa has made available about 10% of its GDP in terms of rescue packages. So far, the information that we have is that it consists largely of 4 different schemes. There's about 130 billion for fiscal spending reprioritization. There's about 200 billion for bank credit guarantee schemes, which also has the largest multiplier effect in the economy. About 70 billion for tax relief, and about 100 billion to protect and to create jobs. Singapore here is at the top of the line. Of course, it's a significantly more developed economy, and Korea and India here at the bottom of the line or of the chart. So South Africa has jumped in with a massive stimulus. The jury is now out to see, can it be implemented? Can it be executed? Can it be done in an efficient way to actually help the underlying economy? What we do know is that there are about 60 million people that are employed in South Africa. That includes formal, informal, agriculture, and private households. And the unemployment pool is about a little bit more than 6.5 million people, according to the latest quarterly labor force surveys from Statistics South Africa. The unemployed number of people can easily increase by between 1 and 2 million people if we look at the effect of the lockdowns are having on the economy. It all depends on the duration of the lockdown and the phasing with which it is in fact lifted. but conservatively estimated from various sources, real GDP growth decline for the full calendar year could easily be -10%. That is an horrendous number. And this will push the fiscal deficit to at least 15% of GDP in 2020. So if we look at what the IMF has said, what they expect will happen in the global economy, they expect the global economy to decline in terms of real GDP growth by about 3% this year. But the important thing is that there's a big bounce back next year to the tune of about 5.8% for the economy as a whole. The global economy is made up of advanced economies and emerging market and developing economies. The effect on advanced economies, the IMF expects to be deeper, to cut deeper into growth compared to the developing world. The developing world is expected to decline only by 1% and then bounce back more significant during the course of next year. If we look at how that growth is actually distributed around the world, we'll find that the area that is least impact is in fact emerging and developing Asia. Sub-Saharan Africa is expected to experience a sharp decline, but more importantly, as I've mentioned, the pickup again next year in 2021. So what can we do and how can we think about this pandemic? I think the largest shock, well, this is definitely the largest shock to the global economy since World War II, even for countries with very little COVID-19 infections. Countries that prevent the additional economic infection or that prevent additional economic infection will certainly be the best off. And it is a very, very delicately balancing act that governments have to pull off here. So crisis management challenge is compounded by huge gaps in knowledge and information about the moment. And I think we can classify these into three things. Many things we know. There are many things that we know that we don't know. There are many things we don't know that we don't know, which is terrible. And there are many things that we know at the moment, which are simply wrong. So there's overwhelming uncertainty in the process of decision making, whether we like it or whether we don't. So I'm going to look at two topics during the next few slides. We'll look at the creation of policy space, and I'm going to look at the use of that actual policy space once it's been created. So where are countries at the moment? So many countries have adopted a lockdown approach, and all the countries and the governments are busy managing these lockdowns at the moment. Attention span is occupied by these measures. What is classified as essential, what is classified as non-essential services, how to enforce the lockdown, how to deal with cheaters, the so-called leaky bucket syndrome that we have, some of it in South Africa, how to protect the families and the companies during the lockdown, how to convert savings into of hungry people or savings into getting money into the hands of people, how to protect people that were retrenched, how to find funds to pay for all of this. So that's why I call it we are at war with ourselves. So some governments have yet to formulate a strategy of how to lift the lockdowns and what to implement thereafter. There is no doubt that an infection peak will follow. It is a known fact. We've seen different modeling for South Africa, probably within the next 3 to 4 months. There are various strategies around the world from extremely gifted people and academics that we've seen. Some includes lockdown with odds and even numbers, but we don't have time to talk about that today. But mitigation measures will simply postpone the infection peak. So the options are wait for herd immunity, as the UK initially did, and then they walked away from that, or wait for the vaccine. Vaccines are not developed in a couple of weeks, in a couple of months. It takes a couple of years. There's an enormous global effort underway at the moment from various associations and big companies and governments in order to speed up that process. But it's unlikely to happen in a couple of months, a minimum probably a year. So the options are, do we sacrifice one, maybe less, maybe more of the population, or do we risk multiples dying of hunger due to the effect on the economy? So the policy space problem, what can we say about that? Well, countries are hit by very large economic shocks. These shocks would have produced recessions even without COVID-19, given the size of these shocks. So lowering economic output due to the restrictions of movements is in fact a consequence. Less economic activity means less tax revenues. And I've heard this morning from Tito estimates that South Africa's tax collection is likely to be 32% less during this fiscal year, given the effect on economic activity. So at the same time, government wish that they could spend more money, but during a time when capital markets are in fact shutting down around the world. So not only the South African government, but many other developing countries' governments now find themselves between a rock and a hard place, a very, very uncomfortable place to be. Governments want to run large deficits. They want to abandon fiscal responsibility during this time of crisis, and it is the right thing to do. If they don't act, we will likely have a situation like we've had from 1929 to 1939 during the Great Depression, where the Federal Reserve sat back and they didn't react soon enough. But government also wants private sector to run large deficits at the moment. They run negative cash flows, and they want us to, private sector to borrow from banks to keep people on the payroll and to keep paying them, to keep doing this until the economy revives. And they want households to use savings, their pensions, their cash, or unemployment insurance, for instance. But what do we know from macroeconomics 101? We know that the public and the private sector deficits are equal to the current account deficit of the balance of payments of a country. And how much a country is spending more than what it is making is in essence the definition of the current account deficit, or if it is a deficit. The current account deficit, however, needs to be financed. Otherwise, you cannot run it. So how do you finance that? Well, you've got two options. You can issue foreign liabilities, loans or bonds, treasury bills, South African bonds, or you can liquidate foreign assets. This is a chart that illustrates the current account deficit as a percentage of GDP for South Africa. So we are already between 5 and 6%, or between 4 and 6% latest numbers of GDP. So it's not as if we have a large buffer there. We're already spending more than what we are earning collectively. But the countries are in very different positions regarding their credit worthiness and their foreign assets. The magnitude of this crisis and weaker countries will require financial assistance because of this magnitude. So countries can borrow at home or they can borrow abroad. And they need to do this preferably with support from the central bank via a very accommodative monetary policy. And the Reserve Bank has come to the party in a great way over the last month during this crisis. And reserve banks can either, or national treasuries, ministries of finance can either issue bonds and allow the central banks to assist to buy those bonds, preferably in the secondary market and not in the primary market. The Reserve Bank has already announced its willingness in order to assist with the secondary market in terms of liquidity, and they've been successful at that. They probably have space to do another estimates that I've heard day before yesterday, about 200 to 250 billion rands worth of that. The use of foreign assets, how much and who owns them. In South Africa's instance, the latest estimates or the latest announcement by the Reserve Bank is South Africa has access to about $47 billion of foreign assets. It is available. We need to restructure and cut non-priority expenditures on budgets. The public sector wage bill has been under the spotlight in South Africa for the last few years. The public sector is cutting their wage bill, so it is expected of the public sector to follow suit. Now, Uruguay has already done this, and believe it or not, it's generated them some good political capital. The trade unions won't be, and labor unions won't be happy with this, but it does distribute the burden and helps liquidity inequality. So something that hasn't been mentioned so far is a potential special interim tax on petrol and diesel at the pump. And the reason I mentioned that is even though the exchange rate, the dollar-rand exchange rate, has depreciated significantly from about 13 to 18 over the last little bit more than a month, the price of oil in hard currency has dropped significantly. So there's significant there's a significant gap for the government in order to not drop the pump price and continue to earn that additional margin on petrol and diesel sales. So if we look at, for instance, the South African bond rates, how the world has reacted after the rescue package to the tune of 500 billion rands have been announced, interest rates have reacted very, very sharply. Interest rates shot up. So in order to issue new debt, it will be significantly more expensive from an interest rate point of view than what it has been prior to February. So what about countries with no creditworthiness on the international side? Well, there are official international lending sources available. There are many institutions internationally at the moment that really want to feel important. But the World Bank, for instance, to put into comparison, only have about $14 billion available. The real money is at the IMF, with about $1 trillion available. They are competent, they are capable, they are willing to assist, and they can do it in a hurry. That's why the IMF is there. South Africa was a founding member of the IMF just after the Second World War. And then debt standstills and restructuring. There is a proposal out from the G20 that debt standstill is announced at least until the end of this calendar year for certain countries and certain types of debt. And this is to allow more borrowing, because the debt servicing cost up until now was just simply too high to take on more debt. So existing debt holders will have to take a haircut, or they have to restructure debt to enable room for new debt to be created. And if they don't do this, well, no new debt is going to be possible. So private sector already does this successfully via corporate finance and restructurings when fresh money needs to be introduced into a business that was already sitting with large debt piles. So this will become, I'm convinced, will become more common over the next few years in the global economy. There's something else as well: creation of new special drawing rights. Special drawing rights, almost as like your shares in the IMF. This was created during 2008 and 2009 during the global financial crisis. And in essence, one can look at this as the so-called monetary emissions on a global scale. But this is a global problem that requires a global solution. It requires a global response. We have seen some proposals which have received great support from around the world. And this is being championed by Gordon Brown, the ex-UK Prime Minister. So what we have in the South African context, it looks like it's all downhill from here. Cyril pushing the economy, a recession coming from the top, COVID crisis waiting to explode in the front, and junk status waiting around the corner. South Africa was already in a recession prior to the pandemic's outbreak. The problem is, given the economic landscape in South Africa cannot afford a one-day lockdown. The recession could easily in South Africa turn into a depression unless very large and efficient distribution of fiscal stimulus is orchestrated. And this will probably be coupled with debt forgiveness. It's not a given in South Africa's instance, but it would be welcomed if it can be negotiated. The distinction, however, between the impact on companies in South Africa, small and medium-sized companies have significantly less resources and less savings at their disposal. And they will be worse hit compared to multinationals, which are, some of them have stronger balance sheet, definitely not all of them, but at least it's easier for them to arrange access to cash if they don't sit on cash. One of the issues that we've seen over the last 4 weeks is what we refer to in the literature as asymmetric distribution of government assistance information, which is compounding the challenge, especially for SMEs. They don't know what the schemes are. The schemes are difficult to get the applications in. There's been great progress in some of those schemes, but it's still not easy to do that. So the price SA is paying is during the lockdown for the cure is the ultimate price. It's in essence, it's the largest portion of the economy, and we suspect that the effect of this may be large-scale unemployment and therefore large-scale widespread poverty. What can we say about the use of policy space? What should countries do with the money that they do receive via this fiscal stimulus? Well, first and foremost, it should be focused on healthcare. Healthcare's budget should be increased. We should have more testing and more monitoring taking place. But there are some natural limitations with regards to health departments. They cannot spend all the money. They have operational constraints, like too few doctors. South Africa has tried to solve that to an extent by importing a few from Cuba. There are procurement obstacles. Everybody is trying to do the same thing during this crisis, but we are arguing that a lack of budget should not be seen as the reason why they don't do more. Support people. First and foremost, I think the focus should be on healthcare, then people, then companies, and then banks. Definitely in that order. The people that need it the most are people that don't have savings. It's a massive income gap that is being created, massive output gap as well during the lockdown. So people should be looked after first. UIF has already been successful in some payouts. Companies, access to bridging loans and liquidity loans, and then banks. And banks will only lend if they know that there's some form of guarantee. Otherwise, if that is not the case, then banks will simply collapse because of bad debt. And so far, the program is not up and running as yet, but the lawyers are still negotiating and sussing out the T's and C's with government before that 200 billion government bank guarantee scheme can be launched, hopefully during the month of May. So far we know that this is not going to be a short war. 4 weeks ago, I thought this might be a short war, but with the information that we've seen coming out so far globally, this is most definitely not going to be a short war. We need to extend the emergency until a vaccine is out, or we need to focus on herd immunity. And that's a very, very tough choice. South Africa does have a leaky bucket system with its parallel economy to a large extent. It's very difficult. It's not, South Africa is not China. For China to keep their society under control is much easier than for South Africa. The lockdown, I think as it's lifted, we'll see the limited effect that it has had. And most people are going to get the virus in any case. It's either during or very soon after the lockdown is lifted. But everybody, I'm going to be very clear here, is not going to die from this. So the South African environment has many everyday deaths prior to this pandemic. We've got thousands of people dying from cancer, tuberculosis, being murdered, road accidents due to HIV, due to malaria, and I can go on with the list. It's hurting the economy to save only a few, and from an economic point of view, it makes little sense. But it's very unpopular to speak about this, and silence is in fact rather preferred. The fast action is popular, but with only economic downside, and this is, from an economic point of view, will do more harm than what it will do good. So fiscal prudency and spending limitations are out of the window for a while, and rightly so. That's the correct time to do this. But we need more international cooperation to expand the options that we have in order to finance the rescue packages. We've seen very little international leadership. The US is missing in action. China has lied about many of the death rates, all of a sudden coming out with new numbers. So we certainly hope, and we are already seeing some of that new ideas of how to protect and recover the global economy will continue to surface, and some of that has already surfaced. So it's not all doom and gloom. It's just very new to the world, and it came very sudden. So the world needs to sit back and think, okay, well, what do we do in order to solve this problem? South Africa is in a very difficult position. After the, we can see during the dotted red line, growth has fallen off a cliff, and fiscal expenditure continued to increase. Therefore, the ratio of debt to GDP has increased significantly. However, if we compare South Africa's debt to GDP ratio with other countries in the world, we'll find that, at least for 2018, which is these statistics represent, is that Japan is more than double the size of its GDP, is actually made up of its debt. Italy in 2018 was sitting at about 135%. After this crisis, massive decline in GDP, the denominator in that equation, massive increase in the additional debt. So Italy's numbers are going to skyrocket. The US has announced between 2 and 3 trillion US dollars of fiscal stimulus. It's also going to increase massively. The difference between South Africa and developing countries, especially the US, for instance, is the US has got a little bit more maneuvering space because they enjoy reserve currency status in terms of the dollar. So South Africa in this chart would sit between sort of Germany and the United Kingdom. After the stimulus, with additional 10% and lower GDP numbers, South Africa's GDP debt to GDP ratio is going to rise to increase to 80%, if not more. So what can we say from a cash preservation and a business rescue point of view? Well, who falls apart in business and jobs depend entirely on cash flow at the moment, and this is worldwide. It's not on the quality of your product, on the quality of your service, but it's on the historical quality of your business, i.e. how much cash did it generate, and did you spend it, or did you invest it, or do you still have access to some of it? To plug the gap, bridge loans should be the focus, and then we've seen that with the 200 billion bank guarantee from National Treasury, which is being negotiated as we speak. The problem is that in South Africa's instance, we should attempt for businesses not to fire or not to let go all employees, for the simple reason in South Africa, we've seen over the history over the last 10 to 20 years, it's extremely difficult for people in South Africa, once they've fallen out of the employment pool, to go from unemployed back to the employment pool. It is extremely difficult. So we don't want them to make the jump from the employment to the unemployment pool. At the same time, we don't want permanent public ownership of the whole economy. We just want it as a temporary measure. And I don't think there's risk of that in South Africa, but in the US, government will certainly taking up not only loans to companies, but also equity in companies. One thing that I want to make very clear here is to focus on rescue schemes and rescue packages that actually work, and make sure that they work efficiently. Not have more schemes that some are not working and some are. Only focus on the ones that are working and do more of that. And only institutions with existing systems in place should do this, should manage this, like banks. And we've seen that bank rescue package, if it can be implemented sooner rather than later, that would be good. The focus, however, should be to plug the income gap. Forget about discrimination, focus on the gap. Keep the receipts of whatever is dished out, monitor those businesses literally on a monthly basis, if not on a higher frequency. Learn from what is happening in the economy and analyze the numbers. So world merchandise trade, and what is the WTO expecting to happen with world merchandise trade? You can see the change in world trade volumes since 2008, the global financial crisis, to the current crisis. The red dip is the forecast in a pessimistic scenario. The green one is a more optimistic scenario. It all depends on the duration of the lockdowns. But you can see that the trajectory for this is coming down. So we definitely will see less global trade as a percentage of GDP in the coming years. There's no doubt about that. One of our largest trading partners, this is China, has announced preliminary GDP figures for the first quarter of this year. And we can look back, that's quarterly GDP and annual GDP on the same chart. It's unprecedented decline in their economic activity. I'm confident that China will probably bounce back quickly, and will probably be some of the larger economies in the world to bounce back the quickest. And that's great for trading partners of China. Australia will benefit from that. South Africa, the raw material exporters, will certainly benefit from that as well. So I've mentioned a lot of things here. Some of them are a little bit doom and gloom. I'm not a prophet of doom, definitely not. Trying to be realistic here with analyzing the situation. I do want to mention that there are a couple of green shoots, and let's quickly go through them. This is the dollar-rand exchange rate of South Africa over the last 5 years. Unprecedented weakness. We've gone to levels over 19 against the dollar this morning. It's a little bit stronger, closer to 18. For exporters, this is great news. This provides a competitive pricing advantage to exporters, for exporters from KZN as well. Exporters should use that. This is not a long-term benefit, it's a short-term benefit. We do expect the rand to come back. How far it will come back is a very difficult guess, but probably between 15 and 16. It's unlikely that it will come back to 12 or 13 because we've unlikely to see so many investment inflows coming into the country after we've lost our investment grade status. So the new normal, and what does the new normal look like? Well, first and foremost, globalization 2.0 has just kicked off. Whether we like it, whether we don't like it, whether businesses were ready for it or not, it doesn't matter, it's here. Autarky is definitely not the answer. Autarky is a term that we use in the literature to refer to isolationism or nationalism. Retreating to isolation will cause more harm than good. We cannot grow our wealth unless it involves some form of international trade. The history is filled with examples from that. But what we will see as a knee-jerk reaction is more isolation, less globalization in the wake of the pandemic. And we're already seeing signs of that. But here's something that I want to offer to the viewers and the listeners. The pandemic likely to escalate the US-China conflict, perhaps to beyond just a trade war. US and China was in a trade war prior to the pandemic, and this is probably just ratcheted up a level. But what KZN and South African exporters shouldn't forget is that because of those significantly higher bilateral tariffs between China and the US, KZN exporters have cheaper access for many goods to China versus USA exporters, and the flip side is true as well. And I think a strategically astute action would include to reduce concentration risk with China. And many countries is going to run with the strategy in the next few years. China is known as the bedrock of the global supply chain. But both on the import side and on the export side, some diversification is necessary unless we want to continue to see these abrupt interruptions. So diversify supply chain sources or find new suppliers and develop those suppliers over time, and diversify the range of export markets, find new and adjacent markets. These markets are perhaps smaller initially, but they will have lower levels of risk, i.e. so it will result in lower export earnings volatility over time. So the essence of that is that, or the result of that, that we want is less boom and bust cycles in terms of international traders. Increased level of digital communication for services delivery. Increased level of digital communication is here to stay, people. It may retreat slightly after the pandemic is something of the past, but it's not going to go back to levels that it was in January, for instance. We communicate in a different way, and we will continue to communicate in this way because it is significantly more efficient than just face-to-face. I want to mention here that services trade is less sensitive to social distancing disruptions. And I can almost say that it's a given that we will see more pandemics in the future. At least the world is learning very fast during this one how to react to it. And we need to, if you are struggling with digital infrastructure and communication, you need to take it a step up. Otherwise, your business will be significantly disadvantaged. Just a very quick slide here on globalization. This is the topic that Martin and I have spoken about over the last year. Globalization is in retreat for the first time since the Second World War. We don't have time to go into details in here, but you can see that the two red areas is the interwar area between the First and the Second World War, where globalization and international trade declined as a percentage of economic activity globally. Then we had the post-war rebound and the liberalization of trade tariffs and trade barriers in the emerging world for most countries, emerging countries in the world. But since the global financial crisis, we've gone into reverse gear, and this reverse gear is going to accelerate over the next few years. So there is forced change on being forced upon us, whether we like it or whether we don't like it. The question is, can you adapt? And those who can will be less hurt, and those who can't will be more hurt. So this is a cartoon that I like to use. The digital transformation is years away. I don't see our company having to change anytime soon, but the wrecking ball in terms of COVID-19 pandemic is there. So at least digital comms is available, and ICT infrastructure is not bad in South Africa, so we need to use this. So to conclude, I want to leave you with an optimistic thought, is that how do you view the world? Do you view the glass as half empty, or do you view the glass as half full? And the reason I mention this is because it's very easy to view the glass as half empty. And if you view it as half empty, I think that's the wrong decision. I think that's wrong. It's the wrong outlook. And the reason I mention that is, even with a 10% GDP decline, the half full argument means that 90% of GDP is still remaining. So it's not as if the economy has evaporated completely overnight. It's just going to be a little bit smaller. And look at it like that. And this is the same for the global economy. And there will be countries around the world, as for instance in the East, which will have less contraction and will have some expansion again. And the last slide I want to conclude with is when it comes to the adjustment. How do we think about this adjustment, and where should we focus? We don't think we should focus on how we are going to survive, but we think we should rather focus on how we are going to change. Because if it's a question of survival, then we continue to do what we did last year. But if it's a question of how can we change in order to adapt to the new situation, to the new world, to the new normal, then we have to be agile, and we need to change, and we need to find a new direction. And if digital is a large portion of that, then we need to adapt and incorporate that in our business practices, and in the way we make policy, and in the way we trade, and in the way we view society. So I think the focus shouldn't be on survival, because that's more of the past. I think the focus should be on change, because there's a far greater probability for prospering if that is the focus. Neville, thank you very much. That is the end of my presentation. I'm going to conclude here. I'm going to stop my screen share. There you go.
Thank you so much for that insightful presentation. I think really food for thought for all of us. We should not be in survival mode, but we should definitely be in a mode that is seeking to ensure that we recover out of the situation. I do have a number of questions, but I think what we'll do is just follow the program, and then when we get to a part where we can then go through a Q&A, then we can then start the Q&A, which would be facilitated by Mr. Cameron. I think if I could just ask Martin if you can come in terms of just comments from your side before we then just go straight into a Q&A.
Neville, I'm going to share my, Neville, can you hear me? I'm going to share my screen. All right. So I thought, based on Neville's request to share a couple of comments, I'm just going to share some 5 odd slides, and then we go into the Q&A session. So the first point is to link on to what was said by Francois at the end, as well as Neville, is that the reality of the matter is, if we think that the new normal is not a real thing, think again. And we need to be flexible to change our ways of doing business going forward. The new normal does not only mean that people will buy and sell and move differently, but also that the global trading environment is going to change. And we'll get to that just now. I think in this context, it's key that you keep track of relevant information to your business, obviously. But we all know cash flow is king. That's unfortunately the reality of the matter in the short term. The focus of these sessions and the discussions are what next, what after, once the lockdown gets lifted and things start moving again, how should we start thinking and going about this? And to emphasize again what Francois was saying is, in change, there's opportunity. You know, the glass is half full. Let's see how we can actually utilize that. And while this is a Chinese saying, the reality is that the big elephant in the room is that the whole world is in this situation. So everybody's looking for alternative markets. Everybody's looking, where do they source from, who do they sell to, and how do they manage through these conditions. So unless you are willing to change, unless you are agile and innovative, you're going to face the masses. I mean, we've in our personal capacity have dealings with Australia and Australian export promotion agencies as well. And in February, when this hit, they were immediately confronted by the businesses in Australia saying, overnight, all our businesses disappeared. China's closed. Where do we go to next? So there's going to be a scramble for business globally, and you're going to see this shift taking place globally as well in terms of trading patterns. It's not going to happen overnight, but if you don't think about this and start thinking on how you're going to trade differently and how you're going to identify opportunities in this context, you're going to miss out and you will probably not survive. Now, in terms of the Q&A session, my suggestion is that you use the tool in terms of the software. I've put a couple of images at the bottom of the screen just to show people if they're unfamiliar with the tool. If you click on participants, you should get a list of the people, and then there's an option there that says raise hand. Once you raise your hand, the administrator of the session can see whose hands are raised in terms of asking a question for those people that do want to take part and actually verbalize their question. If that's the case, I've requested we keep it brief. You state your name, your organization, and then be concise about the questions. You know, this is not a time or place to go on with long, lengthy stories and ranting and raving. We want to know what your challenges are. And in the context of the initiative, what do you see government can do to assist you? We have ideas as to what we can do, but the reality of the matter is people that are in business, that are trading, are the real knowledgeable people in terms of what the challenges are and potentially what the solutions are. So that is what we are interested in for this session. So I would like to open the floor in terms of anybody who is interested in having the voice heard, but as I said, in a focused manner, so that we keep it short. The administrator, if you can maybe just keep an eye for us on who's raising their hands, and then and Neville, I don't know if you have the ability that we can actually allow some people to tell us their issues and their suggestions.
Sorry, just to come in, what the attendee can do is there is a question and answer panel. next to the chat, and if they address all their questions through the Q&A, you'll be able to see them as well and answer them live, or we can answer them offline.
Yeah, I think that we would like to have some of the individuals posing live questions, and also I've seen some of the questions already. I would request that we government people refrain from asking questions, and we will, if there are government questions, we can take those offline, but the main aim of this is to get private sector and industry and exporters and importers to actually pose some questions. So let's see what we can get out of them.
Dennis, I see there's a question from Kolani. Are you able to let him in so that we can hear his question? Kolani, if you can unmute yourself and can you then pose your question, please?
Hi, everyone. Can you hear me?
Yes.
Yes, we can. Please state your full names, your company name, and your question, please.
Hi, everyone. My name is Kolani Ntuli. Company name is XKG Trading Enterprise. We currently are exporting timber to various markets, but mostly in China. We've seen an increase in growth in the business now that China has started slowing their lockdown regulations. But our biggest challenge, and this I've picked up from the local market who's supplying timber, is that the local mills are not taking in any timber, and it now puts, how can I put it? It makes it difficult for us to operate effectively, because the local mills take smaller diameter timber for pulp, and we take the bigger diameter timber, which is for saw logs. So now the farmers are saying they can't supply us for the international market because no one is taking the smaller timber, which is creating a problem because we want to continue. Orders have been now starting to increase, but we're having difficulty in how we're going to assist the farmers to get the smaller diameter timber sold, so we can be able to continue with our normal trade, which is the bigger diameter timber.
Thank you, Kolani. I think so. That's definitely a supply side issue that we can have a chat about. I don't think on this forum we're going to necessarily try and provide answers or resolve any issues. We are interested in obtaining your views as to what the challenges are. So currently, the challenge that you're facing is that because they can't sell the primary product that they are interested, therefore your byproduct is not being produced, and you cannot source to export. So I've noted that. Thank you. Anybody else? There's Ricky Pillay. If you just unmute yourself, Ricky.
Hi there.
There we go.
Yeah, hi. I've been working with the TIKZN since 2014, doing lots of training for the emerging and the advanced exporters. And with the current downturn in the economy, with funds being low, and the trainings would have a serious impact, or the funds would have a serious impact on training. I've put out a number of training videos free of charge that's available on YouTube as well as Facebook, and I'm happy also for TIKZN to share that on their platform to emerging exporters and the advanced exporters. It's just my contribution. It is not a question.
Thank you, Ricky. I think obviously you have the contact information of Claude and Neville, etc., so you can communicate with them on that topic. Thanks.
All right.
Just mute yourself again. Thank you. All right. So,
Martin, I would. Sorry, yes, I would suggest that perhaps we now give an opportunity to Mr. Vili Kutsia to come in and just take us through his presentation from Transnet, and then after that we'll then come back to the Q&A session.
All right, I'm going to unshare my screen.
Thank you. I'd like to introduce Mr. Vili Kutsia from Transnet, who is going to talk about key areas for us to be aware of, both at the import and export level from the Port of Durban, etc. So I'm going to hand over to Vili. If you've got a presentation, you can share that with us. And I'll ask Martin if you can mute your mic, please. Thank you.
Thank you, Neville. Good morning, everybody. Yeah, I think it feels like we're working harder with the lockdown than what we did before. So yesterday we had a conference with Francois and Martin as well, as part of the Durban Chamber of Commerce Trade and Investment Forum. So I think everybody is trying at this stage to make sense of the situation we are in, and speculating is probably the word. Looking at best ways to tackle this, the challenges post the lockdown. I think we haven't had a similar situation in our lifetimes. Maybe during the Second World War and the Spanish flu and those sort of things, there was indications of the situation we're in with lockdowns as such. But the impact of the economy is very difficult to predict. In the 2008-9 global economic crisis, you can look at that and you can sort of look at the trajectory and recovery periods afterwards. But still, it doesn't give you, it's probably, I suppose, 10% of the impact we are going to feel in the next 2, 3, 4 years. So we're all trying to make sense of it. My role at Transnet Port Terminals, I used to be responsible for strategy, and nowadays I'm looking at things like innovation. So we've, from a port perspective, have gone through a whole lot of challenges even prior to the virus, and luckily we've started putting a lot of things in place which we are picking up on. Maybe just to begin at the beginning, we have been in operation and have been working throughout. So the container terminals have been operating probably at 70–80% of capacity. And as from the 2nd of May, 1st of May being Workers' Day, the cargo that hasn't been cleared would start, the days would start counting as if they have been only arriving in the port on the 2nd of May. So in other words, what we have done is we've called it a force majeure and waived the fees of people not being able to get their boxes out in time prior to the lockdown. So I think trying to do a little bit to contribute to the economy. There are things that we have put in place, like compulsory truck booking systems, that has, well, resulted in or delivered some great results during the lockdown in terms of the congestion and things that we had previously in the port having eased. We've had some guys from the World Bank in the Durban Container Terminal, both in December and January, looking at the analysis of the port and looking at ways that we can implement and we can improve. And I'm glad to say that most of the recommendations, even prior to them coming here, we have started working on. We've also had the MEC and the Minister of the Public Enterprises paying us a visit during November to look at some of the issues that we had in the port. And we've started a joint city Transnet Management Committee. And we have implemented, put task teams in place and implement a lot of initiatives in each of these task teams. So Neville and Martin, what I want to do is just to touch briefly on each of these things. I haven't got a formal presentation as such. I think starting at last night's directive that came out, just look at what is the stipulations around the ports and cargo movement. Then I want to talk briefly around the letters to customers and the way we've been communicating throughout the crisis. After that, I want to just look at the current status, give you an indication of the volumes moved through the port. I see if you look outside the window, there's about 21 ships currently at Anchorage. Not all of them waiting to get into the port, but a lot of them not moving because of the crisis. But I just want to talk a little bit about that. And fourthly, I want to talk about some of the World Bank reforms that we're putting in place. And lastly, just touch base on a type of SWOT analysis. Apart from my role at Transnet, I'm also chairing the Trade and Investment Forum for the Durban Chamber. And Donnie from TIKZN is the vice chair on that one. So from the chamber side, we're doing a bit of a SWOT analysis in order to be able to assist people that do trade with some advice on in terms of way forward. As I say, we don't have all the answers. Everybody's grappling and looking at the best way to make sense out of all of this. So if you allow me, I'll do some screen sharing on some of these things. Let's see what I got here. So from last night's letter that came out, I don't know if it's come up yet.
We can see it, thank you.
Okay. The document is called the Risk Adjusted Strategy Regulations of 29 April 2020. So in terms of transportation of cargo, point number 22, rail, ocean, air and road transport is permitted for the movement of cargo to other countries and in the Republic of South Africa subject to national legislation. Essential goods for import, that's carrying on obviously as previously. The import of materials and components required for manufacturing activities allowed under Alert Level 4. So there's a little bit more leeway for the import of goods. Cargo ports of entry. So apart from Mossel Bay and Saldanha, all ports have been declared ports of entry or points of entry. Goods cleared at ports of entry for removal in transit through the Republic destined for neighboring countries. So even previously, we were allowed to export to goods destined for African countries or neighboring countries around us. I think that's been lifted a little bit more now. I see Golani that speaks about timber exports. I'd love to hear if you were able to still carry on with your timber exports during this time. Then permitted goods of export as set out in Annex C to the regulations. I'll look at that quickly. Transport of goods within the Republic of South Africa. Initially, we had some issues to get the cargo out of the port because of the restrictions on movement. And then we wrote a letter of appeal to both the DPE and Department of Transport, and that was lifted to the effect that we were able to move cargo in the port to warehouses around the port area, not necessarily to end destinations like the traders and retailers' warehouses, but to the transporters' warehouses around the port. And then G, any other goods are set out in directions by a relevant cabinet member. So a lot of our customers have written appeals to their minister regulating that sector. And from a mining perspective, there was some lifting of regulations, because initially no mining was allowed, but then they said open cast mining can operate up to 50% of the capacity. Now, last night that has been lifted, so open cast mining can go to full capacity during this time, and other mines can start operating up to 50% of their capacity. So we should be able to export more mining commodities during the next couple of weeks. Yeah, and then just saying the Minister of Transport will be responsible for making regulations around the transport of goods. Just go to section C. Okay, just on the regulation around manufacturing. Manufacturing of wholesale and retail products permitted to be sold under alert level 4, and all input products permitted scaling up to full employment, except for where otherwise indicated, and subject to strict health protocols. Just about the strict health protocols, initially they lifted the regulation for us to move things out of the port, but saying we had to disinfect and make sure that we sprayed all the cargo, which we went back to them and said it's a bit nonsensical, because after between 21 and 30 what days at sea, cargo, all the coronavirus that could have contaminated the cargo has been killed already. So at least they saw the sense in that, and obviously for our employees and for everybody else and goods entering and so on, we need to be vigilant and make sure that we kill all the possible contamination. But for import goods, they didn't make us wash down every container that goes through our ports. Paper and paper products, that's the one for Golani. Manufacturing of plastic packaging, including glass, plastic bottles, etc. So I'll make the rest of the document available to Claude for you guys to share if everybody doesn't necessarily have it already. Then just the second thing I want to talk about is our communication with customers. You'll appreciate that just about every retailer and manufacturer and mine and in the country exports through the ports. So in a way to make sense or to streamline the communication, we mostly communicate through 3 channels. The one is through the organized customer bodies. There's the ships agents and ships owners, SASOA. There's all the clearing and forwarding agents, SAF. And we normally communicate to these guys, and then they distribute them to all the people that they deal with, which then again distribute the communication to the end customer or the actual manufacturer or the mine that's part of the exporters, which is the actual customer that we have in the end. Anyway, so we send these letters regularly to SAF and to SASOA. And secondly, through the Durban Chamber of Commerce, Barry Pillay sends out communication to all the members of the Durban Chamber. regarding the regulations and the communication from the port. Anyway, so what I've got here is one of the letters that's gone out regarding, or during this time, regarding the force majeure, just to say that we are not charging people penalties for cargo being in the port during this time. So after the 30th of April, the penalty days will start, or the first day of entry will start counting from the 2nd of May, and the penalty days then 3 days after that. So normally we've got a 3-day pre-storage period in the port. So the first recognized day of storage for vessels arriving during lockdown will be the 2nd of May. For vessels completing discharge on or before or after 30 April, the standard tariff storage-free days will apply, which is 3 days after arrival. Just on this issue, there's also another World Bank grouping that's doing a study on the cost of doing business in the country, which some of you guys might participate in or be aware of. And because we've got this 3-day free storage where we don't charge people, because what they're doing is not just the cost, but also the duration or the length of time that cargo takes through the whole supply chain. So they're looking at manufacturing cars in Roslyn, in Pretoria, putting it on road or rail to the port, keeping it in our port facility, and then loading it onto a ship and exporting it through the port. So for the export of goods, we've got a 5-day free storage. So 5 days prior to the goods coming into the port, so people can bring the goods, and we won't charge them for that 5 days. Now, and then the other way around. So when we import, or the car manufacturer import parts to go into the cars, we've got this 3-day free storage period before the goods gets loaded onto a ship, or onto a train or a road transporter to take it to Roslyn. So because we've got this 3 days free storage, in the past these guys have recorded that period that it takes for goods to be imported or exported as either 5 days or 3 days, which is totally overstating the reality. Most transporters and owners of the goods are very eager to get their goods in and out of the port as quickly as possible and to the destination. So when a ship comes in and we start offloading, as soon as we open the stack, which is immediately 15 minutes to half an hour after offloading, this stack will be ready for transporters to go and pick up. So very few people actually wait that 3-day period to come and pick up their goods. Just as a side point, while I'm on it, I see Ricky did some free advertising there, so I thought I'll just get my little bit of free air in. What I also wanted to talk about was the status of the current situation in the ports. So currently, as I said, all the container terminals right throughout the country, Durban, PE, Kucha, and Cape Town, are operating at between 70 to 80% capacity. Obviously, from a staffing perspective, we need to adhere to social distancing, same as when you go to Checkers or ShopRite or wherever, where you can't have your full staff complement present all the time, and you need to sanitize and give those PPE and all of that. So in Durban currently we've got 10 gangs. We are busy ramping up to 13 gangs. So we've got 10 gangs currently on shift 24 hours. So our normal 24-hour shifts have been running right throughout this whole lockdown period, and running at about what's it, 70% capacity of staffing. In terms of volumes that we have handling every day, as you know, the Durban Container Terminal handles 2.9 million containers in a year. And the Pier 1 terminal about 700,000. So we are doing currently 3 vessels at the Durban Container Terminal, and there are 4 vessels of the 21 outside at sea that is waiting to be serviced at the container terminal. So that's more or less a normal situation for us. There's only 6 container berths for container ships in the port of Durban. For the Pier 1 terminal, there's 1 vessel that is at berth, and no vessels waiting out at sea to be serviced. At Pier 1, there's 3 gangs. A gang is basically everybody that runs behind a crane. So it's from the crane operator to the straddle carrier operators or the rubber-tied gantry crane operators at Pier 1, to the cargo coordinators, to the supervisors and ops, the whole team that services that particular ship. So we're running at 70% staff occupancy and 80%, 25% operational delivery level. So yesterday, from the planned 5,890 containers that we were supposed to take off at the Durban Container Terminal, we took off 5,718. So it's close to actual. And for today, it's 5,750. So not every day the plan is exactly the same. It obviously depends on the scale of the vessel and same at Pier 1, 1,800, 1,407 taken off. So in terms of the projections for the year, I think we'll get close to the 2.9 million for Pier 2 and the 700,000 for Pier 1 that we are supposed to handle. Okay, then what's on the screen is the Transnet City Management Committee. So as I said, we had our fair share of issues. We had a change in chief executive in September last year. Michelle Phillips came in as the acting chief executive for Transnet Port Terminals. And when she came in, she already started immediately with some sort of reforms and a lot of actions to pick up some of the issues that we've been dealing with. Some of the issues that we have been dealing with, and we had to explain, as I said, to Mr. Gordon and to MEC, we have been sitting with some equipment issues. I think post the whole clamp post the Zuma era, where everybody's been clamping down on corruption. The supply chain and all procurement has just been become a nightmare. It's been very difficult to obtain your equipment in time and to obtain all the parts for maintenance. What we did was, one of the things we did was to bring the guys from National Treasury out to the port, as well as from the DTI. And we said to them, listen, the policies are all fair and well, but the type of equipment that we need to purchase for the container terminals, straddles and rubber-tied gantry cranes, it can't be manufactured in South Africa. We've been paying the 35% levy for local manufacturers to get involved and to build capacity to develop capacity to manufacture themselves. But over the long this policy has been in place, nobody has really developed and nobody has really taken up the slack or the challenge to manufacture. So we need to look at a change to this policy. We're willing to pay that money, but into a fund that gets managed properly, where you can train and develop local manufacturers for this type of equipment. So that was just one of the things we had to deal with. Just probably running out of time, Martin.
Yes.
Okay. Just allow me a minute or two to close off.
Mm-hmm.
Just on the task team. So there's these 9 task or groupings where we started looking at the previous decongestion task team we had in 2017. What are the things that were still outstanding from there? Most of that's been closed down. The second task team is where we put most of our focus in. Look at how the operational performance of the port can be improved. And there's about 30 initiatives that that we've done around that. Amongst others, the supply chain issue I spoke about now. Together with the city, we've looked at state-owned land behind the port that can be parceled for truck staging areas, so that the truck booking system can work properly. On the rail side, we looked at rail reform, short-term improvements that can be made. On number 5, the Port Truck Association accreditation, looking at getting all truck drivers registered, and there was a little bit of pilferage. I think there was about 10 or 13 containers stolen last year. People duplicating permits and all sorts of things. So we're clamping down on that. Number 6 is looking at enforcement with the city, with the authorities, and yeah. So that's basically the task team that we have put in place, and we're getting some good results on that.
All right. Thank you so much, Willie, for sharing that insightful information. I think it's quite technical, and what we'll do is we'll also share your email address with whoever has detailed questions around containers and I know that you've been able to assist a lot with some of the containers being blocked, etc., yeah, which contained essential goods. So I do thank you for that, and thank you for this presentation. I'm going to now hand over to Mr. Martin Cameron, who will then see there's quite a lot of questions that have come through the chat. So I'm sure he'll facilitate that Q&A, and then we'll then bring this session to a close. Martin, I'll hand over to you.
Thanks, Neville. All right, so I've had a look at the questions, and I see that in terms of 2 of the people that asked questions relates to the logistics of transport costs and containers, etc. Narisha posed a question whether negotiations with the shipping lines would be possible. My suggestion on that would be that as organized business groups, one should address the or approach the shipping lines maybe for that purpose. But I think we also need to understand that in the short term, the shipping lines are also all messed up in terms of their schedules and port and container and other supply issues. So one must be cognizant of the fact that they have their own challenges in this regard. Also keeping in mind that while we can request certain things, it also depends on what happens on the other side of the equation in terms of the destination ports and what governments are doing there. So it is a bit of a challenge in that sense. The transport cost question that who was this that asked the question about, I think it was Ben Liebenberg. We saw that container traffic was totally messed up when China closed down. That has been sorted, so logistics are flowing there, but because of the knock-on effect, it hasn't had an impact on container and container availability globally, because the containers are generally owned by the shipping lines in most cases, not by the exporters. So to schedule things is a problem. So your question was, will the cost be higher than it used to be? Because just before lockdown, the transport cost of goods skyrocketed. We saw that the biggest change in costs were associated with air transport. And the reason for that is that the bulk of airlines' actual business comes from passenger movements. So globally, the airlines in value terms are responsible for moving about 35% of global trade in value terms, but about 1% in volume terms only. So the big money spinner for them is, and that keeps them afloat, are the traffic of passengers. And with all the lockdowns you saw in the news, Virgin, BA, etc., they are all in trouble as a result of that. So my kind of take on it is that in the short to medium term, air traffic is going to be expensive, simply due to the fact that the airlines have not been able to adjust yet to switch over to containerized traffic. Although in America we saw some of the airlines, they started using passenger planes to move goods, just to stay afloat in the short term. In the longer term, it will depend on whether they actually survive. And if they survive, one will definitely see the prices coming down. On the maritime side, I see what's going to happen is that the prices will stay a little high for the short term, but then as other markets all open up, again, you'll have competition, and the shipping companies would be eager for business. So I'm sure we will see a drop in prices as a result of that. But in the next 3 to 6 months, this may still be volatile and may still be higher than what we used to see. Okay. In terms of the questions, Francois, you had a question that was posed that you would like to respond to, if I can put you on the line.
Thanks, Martin. Yes, the question related to Cosmos's question regarding the debt levels in South Africa, and whether I'm concerned about the overall debt level of government as a percentage of GDP. The answer is yes, I am concerned. But we should really try and see this in perspective. The additional debt is due to the fact that there will be fiscal stimulus. So it's good that there is additional debt in order to do that. Remember, the reason we need stimulus, is fiscal stimulus, is because of the way we've reacted to the outbreak of the pandemic. We've reacted in a similar way than what most countries around the world has reacted. We can debate that, but that's not, I don't think that's for today. What do international rating agencies look for when they look at debt levels? They are concerned about the actual ratio, debt to GDP, but what is of far greater concern to them is how does the rate of debt change compared to the rate of GDP? And in South Africa's instance, over the last, since 2008, our ratio of debt to GDP has only increased. And a couple of weeks ago, we lost our investment grade rating. I think Moody's was the last one to respond. And now, in order to issue bonds in hard currency and in local currency, we'll be penalized due to that classification change. The biggest thing that South Africa can do is to unlock all potential obstacles to growth in South Africa, so that the South African economy can grow as fast as possible, so that we can literally grow out of the debt trap that we are finding ourselves in right now. And the minute they see signs that that is coming through from policymakers, they react in a favorable way. So what we should do from a policymaking perspective is making it as easy as possible for business to do business, removing all the potential obstacles that we have control over, so that more business can be done, so that economic activity can pick up, so that GDP growth can be as fast and as intense as possible. Because the rate of growth in GDP needs to be faster than the rate of growth in debt. And the minute those signs are coming to the market, they will react in a favorable way. And so what concerns me is that that has not been the case, and that hasn't been the case over the last 10 years, and we're going in the wrong direction. But that is completely reversible. It is within our powers in this country in order to change that. We just need to focus on that and make sure that that is implemented in a very single-minded way. So that's all that I wanted to say on that, Martin. Thanks.
Thanks, Francois. All right. I think in terms of time, we're going to start wrapping up. I want to share my screen with you again. Let me just quickly do a screen share of the correct information here. All right. So Are you guys seeing the next steps? If you can just indicate to me that you have it correctly in front of you. Right. So the first thing for companies and for people that are not attending but that you are aware of as attendees, please communicate this to them, is that in order to assist you, Trade and Investment KwaZulu-Natal and the government obviously needs to know about you, and more importantly needs to know about what the challenges are. There were some good questions here, and we will put some responses to the questions in a more formal format together after the session. But the idea is also to have upcoming future more focused webinars within specific sectors and exporter and importer groups. And also we may be using questionnaires and other means of surveying. So we ask people to please be flexible and take part in providing information and feedback, because otherwise it's extremely difficult to assist. And also, if you do talk to other people, get them on board. The more information we have, the more we can build a view of what's going on, where the constraints are, what the needs are, the better we can assist. If we don't know what the challenges are, we cannot assist. And then one should not complain that the government is not helping, because they can't help if they don't know. So with that, I'm going to hand back to Neville to wrap up the session for us. And thanks for your attendance so far.
Thank you so much, Martin. I think let me take this opportunity to thank everyone that has participated in the session, and to all those attendees, as well as those that are streaming on YouTube as well as Facebook. I want to thank you for this opportunity. As Martin has said, we will have a follow-up, more dedicated and more targeted session. Today really was to gather input and to share, what the work stream has done so far. If I can just thank the convener and the co-convener, Ms. Busi Mabusa, as well as Martin Cameron, for your sterling work and your guidance and your leadership. We thank you very much for that. I want to thank Francois for your input and your valuable input always. You always tease our brains all the time, so thank you very much for that. Willie, input from a port's perspective, and what companies should be looking out for is really appreciated. I'd like to thank the engine room behind all this, the team behind it, Claude Moodley in particular, who's been driving this, supported by Farai, Sihle, and also the technical team, Dennis, as well as Steve, who really have been assisting us with technical glitches and making sure that we are ready to run. As I mentioned, there's a series of these. There'll be 2 more today. One that will start at 2, which is specifically focusing on industry development, and the last one at 5:30 this afternoon on infrastructure development. So we look forward to your participation in all these sessions, and this brings us to the end of this webinar. Thank you very much, and God bless.